Hi, my name's Fiona. I'm literally just recording this so I can play it while I sleep. I'm studying for the CMA exam, CMA exam part 2. Um, yeah, I mean, if this is helpful for you, great, but really, this is just for me. So, I'm just going through flashcards that I can listen to it while I'm asleep, and hopefully, I can absorb some knowledge through osmosis. So, okay, here I go. Maturity matching. It equalizes the life of an acquired asset with the debt instrument used to finance it. Hedging. So this is hedging, which mitigates financial risk. Return on equity. So for this study unit, there's some extra formulas for return on equity. It's like one formula, but with two steps. So first, you need the dividend yield, which is the expected dividend divided by the current market price. And the expected dividend, remember, is the current year dividend times parentheses 1 plus the dividend growth rate end parentheses. So dividend yield is that expected dividend divided by current market price. That gives you dividend yield. But you're not done yet, because step 2 to get this return on equity is you take that dividend yield and add that constant growth rate. That equals return on equity. Stock value under the constant dividend growth model, also known as the cost of new common stock, also known as the constant dividend discount. Sorry. So, stock value under constant dividend growth model. Stock value, also known as cost of new common stock, and the dividend growth model, also known as the constant dividend discount model instead of growth. So first, you take expected dividends per share and divide that by discount rate minus dividend growth rate. So that's actually what you do. Expected dividends per share divided by discount rate minus dividend growth rate. And then I expand that formula out a little bit more. So expected dividends per share, the numerator, is the current year dividend times parentheses 1 plus the dividend growth rate end parentheses. And you divide that numerator by the discount rate minus the dividend growth rate. The two-stage dividend discount model. So the funny thing is, and the way this was explained to me, it's 2 stages, but really there's 3 steps, which is kind of silly. So the first step is you calculate and sum the present value of dividends in that period of high growth. And step 2 is you calculate the present value of the stock based on a period of steady growth, i.e. the constant growth dividend model. And the way you do that is you take that expected dividend per share divided by the discount rate minus the dividend growth rate. So like that, what we just talked about before. And remember, you're discounting that back to year 1. And then you take what we just did there, and also that first thing we did, the calculating and summing the present value of dividends in a period of high growth, and we're adding them. So again, to do the 2-stage dividend discount model, you find the sum of the present value of dividends in a period of high growth, and you find the present value of a stock in a period of steady growth, and you add those. Cost of equity capital under the dividend growth model. This is the expected growth rate plus parentheses the next dividend divided by current market price. So again, the cost of equity capital under the dividend growth model is expected growth rate plus parentheses next dividend divided by current market price. And the cost of equity capital under the dividend growth model assumes the payout ratio, retention rate, and earnings per share growth rate are all constant. Cost of preferred stock capital. This equals the annual dividend divided by the quantity of funds from issuance. So, the cost of preferred stock capital, annual dividend divided by quantity of funds from issuance, we can take that further, saying that the cost of preferred stock capital is the annual dividend divided by proceeds minus issue costs. Okay, so the cost of preferred stock capital is annual dividend divided by proceeds minus issue costs. So for the cost of preferred stock capital, dividends in general for preferred stock, dividends are not deductible for taxes. So the effect of income taxes is ignored. Value of preferred stock paying a fixed dividend. That is calculated by dividend per share divided by cost of capital. So again, value preferred stock paying a fixed dividend, dividend per share divided by cost of capital, where the cost of capital equals the investor's required rate of return, which is calculated using the CAPM method, which is the fixed rate plus beta times parentheses market rate minus fixed rate. So that's RF plus beta times parentheses RM minus RF. Current component cost of debt is the effective rate times 1 minus the marginal tax rate. Again, current component cost of debt is the effective rate times 1 parentheses 1 minus marginal tax rate. That was the current component cost of debt. The cost of new debt is the annual interest divided by the net issue proceeds. So again, cost of new debt, annual interest divided by net issue proceeds. The current component cost of preferred stock is the cash dividend on preferred stock divided by the market price of preferred stock, which actually equals the dividend yield. Okay, so the current component cost of preferred stock is the dividend yield. The dividend yield for preferred stock, which is the cash dividend on preferred stock divided by the market price of preferred stock. The cost of new preferred stock is the expected dividend divided by net issue proceeds. Again, cost of new preferred stock is the expected dividend divided by net issue proceeds. And remember, the expected dividend is current year dividend times parentheses 1 plus the dividend growth rate. The current component cost of common stock is dividend yield for common stock. So cash dividend on common stock divided by market price of common stock. So that's pretty easy to remember, but the cost of new common stock is a bit different. It's that expected dividend divided by net issue proceeds plus the dividend growth rate, okay? So maybe I'll try saying this a different way, just so that way you don't, if you're just listening and you don't have this flashcard in front of you, you don't think that the adding is in the denominator or something, okay? So the cost of new common stock is the dividend growth rate plus expected dividend over net issue proceeds, okay? Current component cost of retained earnings is equal to the current component cost for common stock. And remember, that's the dividend yield for common stock, which is the cash dividend on common stock divided by the market price of common stock. So that's easy to remember. The current component cost for retained earnings is the same as that for the common stock. So if you already calculated it for common stock, congrats, you already calculated the current component cost of retained earnings as well. Okay. So cost of X. So just some certain things. I just put a few of them on the note card. So the after-tax cost of debt equals the current market yield percent times parentheses 1 minus the tax rate. So again, the after-tax cost of debt equals the current market yield percentage times parentheses 1 minus the tax rate. The cost of preferred stock, if it's trading at par, equals the annual dividend rate. So again, the cost of preferred stock, if trading at par, is the annual dividend rate. The cost of common stock, or also known as common equity, through the dividend growth model equals the expected dividend. So through the dividend growth model, first you have to calculate the dividend yield, right? So that's expected dividend divided by market price, which then you can use that to get the component cost of common stock, which is that dividend yield percentage plus the dividend growth rate. Weighted average cost of capital. That's preferred. Okay. Give me 1 second. the weighted average cost of capital is the preferred stock weight times the return, and return is component cost. So let's start again one more time. The weighted average cost of capital is preferred stock weight times that return plus common stock weight times that return plus long-term debt weight times parentheses the return times parentheses 1 minus tax rate end two parentheses. And weighted average cost of capital with the capital expansion of X for next year, there's a couple steps for that. So first step, you find the debt, the common stock, and retained earnings to maintain the capital structure as a percentage of X. And then you take what you found for debt, common stock, and retained earnings in step 1 and divide it by, for debt, divide it by parentheses X times the after-tax cost of debt from financing percentage, and you add what you found for common stock divided by parentheses X times the cost of common stock percentage, and you add that to what you found for retained earnings divided by X times cost of retained earnings percentage. All right. Average accounts receivable, there's a lot of different formulas for this. So there's the obvious one, beginning accounts receivable plus ending accounts receivable divided by 2. So you're dividing by the 2 periods, beginning and ending. Another formula for average accounts receivable is daily credit sales times average collection period. Again, daily credit sales divided by, not divided. I don't know if I said divided the first time, but I definitely said it that second time. Average accounts receivable, daily credit sales times average collection period. Daily credit sales times average collection period. Another formula, or a couple formulas, they're pretty similar. Net credit sales times parentheses average collection period divided by days in year. Net credit sales times parentheses average collection period divided by days in year. And pretty similarly, instead of net credit sales, it's still basically the same thing. Sales for the month times parentheses average collection period divided by days in year. A different formula is for average accounts receivable is net credit sales divided by the accounts receivable turnover ratio. And remember that I haven't said in this video, but the accounts receivable turnover ratio is net credit sales divided by average accounts receivable. So if you have net credit sales divided by the AR turnover ratio, what you really have is net credit sales times average accounts receivable over net credit sales. So those two cancel out and you're left with average accounts receivable. Cost of factoring. There's 5 steps for this. The first one, the amount the firm will receive from factoring equals the receivables amount times the advance percentage minus whatever reserve and whatever factor fee or commission there is. Okay, so the second step is to find the annual interest expense for factoring, which is the amount the firm will receive from factoring times the annual finance charge. Step 3, you're finding the annual factor fee, which is the accounts receivable, the amount the firm will receive from factoring so the accounts receivable times the factor fee percentage, which equals the monthly factor fee probably, and then you multiply that by 12 months. Then you have to find annual net cost, which is the annual interest expense plus the annual factor fee minus the amount the firm will receive from factoring. And then finally you find the effective rate, which is the cost of factoring, which is that annual net cost divided by usable funds. And usable funds is that amount the firm will receive from factoring. So that's the amount actually the firm can use. Okay. Next, annual income from a lockbox service. So the benefit or loss from a lockbox service is the interest earned minus the cost. And you find that by doing parentheses daily cash receipts times reduced collection time times the money market rates, in parentheses, minus, parentheses, lockbox service costs times months and year, in parentheses. Since this lockbox service costs are probably like given to you per month rather than the annual part. But if it was the annual, then you just have to subtract that instead of doing months in a year. Net float. That equals, parentheses, average daily collections minus average daily checks written, end parentheses, times collection period for checks in days. So let's do that again. Net float is, parentheses, average daily collections minus average daily checks written, end parentheses, times collection period for checks in days. Formula for annual benefit of reducing float on cash collections. That equals daily cash receipts times days of reduced float times opportunity cost of funds, where the opportunity cost of funds is the annual rate of return on short-term investments. That's what you're missing out on in order to increase the cash collections. So again, that formula for annual benefit of reducing float on cash collections equals daily cash receipts times days of reduced float times the opportunity cost of funds. And that opportunity cost of funds, annual rate of return, that's going to be a percentage. Increase in average cash balance. That equals the daily cash receipts times days of reduced float. So, increase in average cash balance is equal to daily cash receipts times days of reduced float. Okay, well, never mind. Ignore that. Let me say that one more time. Increase in average cash balance equals daily cash receipts times days of reduced float. Calculate cost of change in credit terms. That equals increased investment in receivables times the opportunity cost of funds. And again, the opportunity cost of funds is that annual rate of return on short-term investments. So if you're increasing the amount of time that someone can take to pay you, that money's stuck in receivables instead of cash, so you're not able to invest that money, so you're losing out on whatever that market rate is in the short term. So that's that opportunity cost coming in. So again, the calculate cost of change in credit terms is that increased investment in receivables times the opportunity cost of funds. Some formulas for average inventory. There's the obvious one, current year plus prior year divided by 2. There's also inventory per order divided by orders per month. So average inventory per order divided by orders per month, or total order quantity divided by 2. Inventory carrying costs. These are incurred to hold inventory. And some examples are warehousing costs, insurance costs, cost of capital invested in inventory, inventory taxes, cost of obsolescence, and cost of spoilage. Something that's not an example of inventory carrying cost would be shipping, because that's going to happen whether you hold on to the inventory or you immediately sell it. So that's a sunk cost. Calculate the total cost of carrying safety stock. That is equal to the expected stock out cost plus the carrying cost. So again, the total cost of carrying the safety stock is the expected stock out cost plus the carrying cost. Selling price with desired return on equity. So first, you have to find that return on equity. So that's net income divided by equity. And if you want to define net income, let me restart. So, selling price with a desired return on equity. You already know your return on equity. What you need to find is the net income, right? And you find net income and you then figure out the selling price from that. So you know the return on equity formula, which is net income divided by equity. So you know return on equity, you know equity. Net income is equal to equity times return on equity. So now you've got net income, where net income is equal to the selling price minus the variable cost times units sold minus those total fixed costs. So when you rearrange that, you find selling price. And selling price is equal to net income plus fixed costs plus variable costs divided by units sold. Order quantity that minimizes the sum of ordering and stockout costs. This is the EOQ model. EOQ equals the square root of 2AD all over K, where A is the fixed cost per purchase order, so the ordering costs. D is the periodic demand in units. K is the carrying costs per unit. So again, EOQ model, order quantity that minimizes sum of ordering and stockout costs, is the square root of 2 times the ordering costs times the periodic demand in units divided by those carrying costs per unit. Reduction in average collection time that justifies a lockbox. That would be the cost of the lockbox each year divided by the potential return on daily collections. So the reduction in average collection time that would justify a lockbox is the cost of the lockbox each year divided by the potential return on daily collections.